Hey everyone, welcome back to Corporate Decoder. Today, Friedman Industries Inc. filed its Pre-14A, and I am seeing a massive change in how shareholders can control the company's rules. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing is all about setting up the next shareholder meeting. And it looks like shareholders might get a lot more power to change company rules. Alright, so we're looking at Friedman Industries here, a company in the steel business, and they've just put out their preliminary proxy statement for their upcoming shareholder meeting. This is basically the document that tells shareholders what is going to be voted on at the meeting and gives them information to help them decide how to vote. The meeting is scheduled for the 22nd of September 2026. This notice lays out the key things shareholders will vote on. First up, electing 6 directors. Then a vote on the company's executive pay, and this is an advisory vote, meaning shareholders give their opinion, but the board doesn't have to follow it. They'll also vote on ratifying Baker Tilly Us. LLP is their accounting firm for the next year. But the really interesting part is Proposal 4. This proposal is a big deal. Currently, the board of directors has a lot of control over the company's bylaws, which are like the internal rulebook. This amendment would give shareholders the power to amend the bylaws too, but it requires a supermajority vote 75% of all outstanding shares. This is a significant shift, giving shareholders more say in the company's governance. It is like giving the people who own the company a louder voice in how it is run. Looking at the director nominees, we see a mix of experience. Mike Taylor, the president and CEO since 2019, has deep roots in the steel industry. Max Reichenthal, president of Texas Iron and Metal, also brings extensive knowledge of the steel business. Sharon Taylor, the executive vice president and chief financial officer of Martin Midstream Partners, is noted as a financial expert. The board believes all nominees except Mr. Taylor are independent, which is crucial for good corporate governance. The company emphasizes that they are looking for directors with a broad range of skills and experiences. They want people who understand business and finance, have a track record of accomplishments, genuinely care about shareholders, and are committed to the company. They're not just filling seats, they're trying to build a board that can effectively steer the company. For the fiscal year ending the 31st of March 2026, directors earned a base of $9,000 per quarter. Additional fees were paid to the chairs and members of the audit committee. It is interesting to see that director compensation includes restricted stock awards. For example, Michael Hansen received $10,000 in other compensation, which was restricted stock. This is a common way to align directors' interests with those of shareholders. However, it is worth noting that Tim Stevenson, who is retiring from the board, received $55,000 reflecting his service. Now let's dive into executive compensation. Shareholders will vote on the pay of the company's top brass. The company is asking shareholders to approve the compensation of its named executive officers, or NEOs. This is that say on pay vote. Looking at the summary compensation table for fiscal year 2026, the numbers are quite striking. The CEO Michael J. Taylor received a total compensation of over $2.7 million. This includes a base salary of $750,000, a large bonus of over $1.2 million, and stock awards valued at over $718,000. Alex Laru, the CFO, also saw a significant increase, with total compensation reaching over $870,000, including a substantial bonus. Then there is Gaurav Chibba, the Chief Operating Officer, who only joined in July 2025 but had a total compensation of over $2.5 million in the fiscal year ending March 2026, heavily weighted towards stock awards and a massive bonus of over $1.1 million. This big jump in bonuses for the CEO and CUO in 2026 compared to 2025 is something shareholders will want to understand. The company also has outstanding equity awards. For example, Michael J. Taylor has restricted stock that will vest over 3 years, and Gaurav Chibba has shares vesting in 2 installments in late 2026 and 2027. The market value of these unvested shares for Mr. Chibba alone was over $886,000 as of the 31st of March 2026. This is a significant amount of compensation tied to the company's future performance. This pay versus performance table is designed to show how executive pay relates to the company's financial performance. Let's look at fiscal year 2026. The compensation actually paid to the CEO was over $2.8 million, while the average for the other named executive officers was about $1.8 million. This was against a net income of about $19.5 million. Compare that to 2025. Where the CEO's compensation was much lower, around $662,000, and the net income was significantly less at $6 million. It appears that in fiscal year 2026, a substantial portion of the reported compensation was bonuses and stock awards tied to that higher net income. When we look at who owns the company, Dimensional Fund Advisors LP is a major holder with over 538,000 shares, representing about 7.5% of the company. Delisle Partners LOs with nearly 420,000 shares, or 5.8%. The CEO, Mike Taylor, holds about 253,000 shares, which is 3.5%. The executive officers and directors as a group own about 6.6% of the company. This tells us that the big institutional investors and management itself have a significant stake. Next up is a look at their auditor. The company is recommending the ratification of Baker Tilly US LLP as their auditor for the fiscal year ending the 31st of March 2027. It sounds like Baker Tilly is actually the same firm as their previous auditor, Moss Adams LLP, due to a merger that happened in June 2025. The fees for their auditors are listed here. For fiscal year 2026, the audit fees were about $864,200, and for 2025, they were around $724,500. These are the costs associated with checking the company's financial books. Let's circle back to that really important Proposal 4. This is the one that gives shareholders the power to amend the company's bylaws, as long as they get that 75% supermajority vote. This is a powerful check and balance. It means shareholders aren't just passive observers. They can actively influence the company's rules of operation if there is enough consensus. This is a significant move towards greater shareholder democracy within the company. It demonstrates a willingness from the company's leadership to address potential shareholder concerns about control. Looking at the Audit Committee charter, its main job is to oversee the financial reporting and audit process. They have the sole authority to hire and fire the independent auditor and approve their fees. They also review financial statements and internal controls, making sure everything is on the up and up. This committee plays a vital role in ensuring the integrity of the company's financial reporting. The Compensation Committee's role, as outlined in its charter, is to oversee executive compensation. They review and approve salary, bonus, and equity awards for the CEO and other top executives. They also look at overall compensation policies to make sure they attract and retain talent and align with shareholder interests. This is the committee that is behind those big bonus numbers we saw earlier. Finally, the Nominating Committee is responsible for identifying and recommending director candidates. They look for individuals with strong business and financial backgrounds, integrity, and a commitment to the company and its shareholders. They're the gatekeepers for who sits on the board. In conclusion, Friedman Industries is proposing a significant shift in governance by giving shareholders the power to amend the company's bylaws with a supermajority vote. This, combined with the advisory vote on executive compensation, suggests a move towards greater shareholder influence. The company's financials for fiscal year 2026 show substantial bonuses and stock awards for top executives, heavily tied to performance metrics like net income. While the company has strong institutional backing, the upcoming shareholder vote on bylaws could be a pivotal moment for how much say shareholders truly have. The risk I am watching is whether the 75% supermajority makes it truly difficult for any bylaw changes to pass, despite the initial proposal. What I am actually looking for is how the market reacts to this increased shareholder power in the coming months. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, subscribe, and join our Discord for more.